Hello and welcome back. Most of us believe something very simple about banks. We think that when we deposit our money, the bank stores it safely, keeps it untouched, and gives it back whenever we need it. We imagine vaults, digital ledgers, security systems, and a quiet place where our savings wait patiently for us. But that image is not just incomplete, it's misleading. Because the moment your money enters a bank, it stops being idle. It starts working. Not for you, but for the bank. Banks are not storage facilities. They are businesses. And like any business, they exist to make money. The surprising part is not that banks make money. The surprising part is how deeply your own money is involved in that process, often without you realizing it. Let's start with a simple question. When you deposit $1,000 into your bank account, where do you think that money goes? Most people assume it stays there, but in reality, only a small fraction of that money is kept as cash or reserves. The rest is immediately put to use. Banks operate on a system called fractional reserve banking. This means they are only required to keep a small percentage of deposits on hand. The rest can be loaned out, invested, or used to generate returns. So if you deposit $1,000, the bank might keep only $100 in reserve. The remaining $900 can be lent to someone else, a mortgage borrower, a business owner, or a credit card customer. That borrower pays interest on the loan, and that interest becomes profit for the bank. Here's where it gets interesting. That $900 you deposited doesn't disappear from your account. You still see $1,000 on your screen. At the same time, someone else is spending that same money. In effect, the bank has created economic activity using your funds while promising you full access whenever you want it. This system works because not everyone withdraws their money at the same time. Banks rely on predictability, patterns, and trust. As long as withdrawals remain manageable, the system functions smoothly. But the key point is this: your money is not sitting still. It is being multiplied, and the bank earns money from that multiplication. The most obvious way banks profit is through interest. The difference between what they pay you and what they charge borrowers is called the interest spread. For example, your savings account might earn you 1 or 2% per year. Meanwhile, the bank might charge 6, 8, or even 20% on loans and credit cards. That gap is not accidental. It is the core of the banking business model. Even when interest rates are low, banks still benefit because they operate at scale. Millions of deposits, millions of loans, small margins multiplied across massive volumes. What looks insignificant on your statement becomes enormous at the system level. But interest is only the beginning. Banks also make money through fees. Monthly maintenance fees, overdraft fees, ATM fees, late payment fees, international transaction fees, account inactivity fees. Many of these charges are small enough to feel harmless, but frequent enough to generate billions collectively. In some cases, fees generate more profit than lending itself. Then there's something most people never think about. Banks invest your money, not just in loans, but in financial markets. Government bonds, corporate bonds, securities, sometimes even complex financial instruments. While regulations limit risk, banks are still actively managing capital to generate returns. When markets perform well, banks benefit. When markets perform poorly, losses are often absorbed quietly or shifted through accounting mechanisms most customers never see. Another layer is timing. Banks earn money simply by controlling when money moves. They receive deposits instantly, but delay payments. They process interest daily on loans, but credit interest monthly to savers. Even small timing advantages create profit through float money that exists in transit. None of this is illegal. None of it is secret, but it is rarely explained clearly. The system depends on one crucial thing: your trust. You trust that your money will be there. You trust that the system is stable. You trust that banks know what they're doing. And historically, that trust has been reinforced by governments, regulations, and guarantees like deposit insurance. But that trust also creates a strange imbalance. Banks take relatively low risk with other people's money, while individuals carry much of the emotional and financial burden. If investments succeed, banks profit. If the system fails, society often pays the price. This is not about blaming banks, it's about understanding incentives. Banks are designed to extract value from stability. The more predictable your behavior, the more profitable you become. Regular deposits, minimal withdrawals, long-term loans, passive savers, these are ideal customers from a banking perspective. The irony is that the very behaviors we're taught to believe are financially responsible, saving quietly, avoiding risk, trusting institutions often generate the least personal benefit while producing the most institutional profit. And most people never question it because the system feels normal. It's familiar. It's always been there. But once you understand that banks don't simply hold money, they leverage it, the entire relationship looks different. Most people think banks make money only when they give out loans. That's partially true, but it's far from the whole picture. In reality, banks make money even when you are not borrowing anything, even when you're just quietly living your life, swiping your card, checking your balance, and assuming nothing significant is happening in the background. Let's talk about deposits again, but this time from the bank's perspective. When you deposit money, the bank doesn't see it as your money sitting safely. It sees it as low-cost fuel. Deposits are one of the cheapest sources of funding banks have. They pay you almost nothing for the privilege of using your money, especially during low-interest periods. That means your savings account isn't just a service, it's a resource. Banks then transform that resource into higher-yield assets: mortgages, business loans, auto loans, personal loans, credit cards. Each of these products carries a different level of risk, but also a different level of return. And here's the key point. Banks don't need every loan to succeed. They only need the overall portfolio to remain profitable. This is where scale matters. One person defaulting on a loan is insignificant. Thousands defaulting can still be manageable. Losses are absorbed, written off, restructured, or covered through reserves. Meanwhile, interest continues flowing in from millions of other borrowers who are paying on time. The system is designed to tolerate failure as long as it's distributed. Now consider credit cards. They are one of the most profitable products banks offer. Why? Because credit cards combine high interest rates with behavioral predictability. People don't treat credit card debt the same way they treat other debt. Small purchases feel harmless. Minimum payments feel manageable. Balances quietly roll over month after month. A credit card charging 18 or 20% interest doesn't need aggressive enforcement. It relies on habit, and those habits generate enormous revenue. Late fees, penalty interest, balance transfers, annual fees, all built into a system that feels optional but quickly becomes sticky. Then there's something even more subtle. Banks earn money by creating dependency. Once your salary is deposited into a specific account, your bills are linked, your subscriptions are connected, your cards are active, and your credit history is tied to that institution. Switching becomes inconvenient. Not impossible, but uncomfortable. That friction is valuable. Banks know that most people will tolerate small inefficiencies rather than disrupt their financial routines. A slightly higher fee, a slightly lower interest rate, a slower customer service response, these things accumulate but rarely trigger action. Over time, that passivity becomes profit. Another major source of income comes from payments. Every time you swipe a card, tap your phone, or pay online, banks are involved. They earn interchange fees from merchants. Individually, these fees are tiny, but multiplied across billions of transactions, they become massive. And consumers rarely notice them because the cost is hidden inside prices. You don't feel like you're paying the bank when you buy a coffee, but you are. Banks also benefit from information. They know how people spend, save, borrow, and struggle. This data helps them price risk, design products, and target offers with precision. While privacy rules exist, behavioral patterns still shape decisions behind the scenes. Another overlooked factor is time. Banks think in decades, individuals think in months. A bank doesn't need you to be wealthy. It needs you to be consistent. Even modest incomes, if predictable, are extremely valuable over long periods. 30 years of steady mortgage payments are more attractive than short-term wealth. And here's where the power imbalance becomes clear. Banks can wait. People often cannot. When financial stress hits a job loss, a medical emergency, a recession, banks tighten conditions. Credit becomes harder to access, fees increase. Interest rates rise for riskier customers. At the exact moment people need flexibility, the system becomes stricter. This isn't cruelty, it's design. Banks are structured to protect themselves first. Regulations reinforce this. Capital requirements ensure banks survive shocks. Liquidity rules ensure they can meet obligations. From a systemic perspective, this makes sense. A collapsed banking system harms everyone. But from an individual perspective, it often feels one-sided. During economic expansions, banks encourage borrowing. During contractions, they punish risk. The cycle repeats. And throughout it all, deposits remain the foundation. Your money remains the engine. What makes this even more powerful is that most people participate without choice. Salaries must go somewhere. Bills must be paid. Digital transactions require intermediaries. Opting out of the banking system is possible in theory, but extremely difficult in practice. This creates a captive relationship. You need the system more than it needs you. Yet despite this, banks rarely appear threatening. Their branding emphasizes safety, trust, stability, and service. Branches are clean, apps are friendly, language is reassuring. The complexity stays hidden, and that's why the system works so well. Because when something feels ordinary, it stops being questioned. Most people think banks are just safe places to store money. You deposit cash, they keep it secure, and you withdraw it when needed. But behind that simple idea is a system far more complex and far more profitable than most people realize. When your money sits in a bank, it is rarely sitting at all. Banks operate on a principle called fractional reserve banking. This means they are only required to keep a small percentage of total deposits as actual cash. The rest is actively used to generate profit. Let's say you deposit $1,000. The bank may only keep $100 as reserve. The remaining $900 can be loaned to someone else. That borrower spends the money, and the person who receives it deposits it back into the banking system. Now the bank can loan out a percentage of that deposit too. This process repeats again and again, multiplying the impact of your original money across the economy. This is how banks effectively create money, not by printing it, but by expanding credit. Every loan issued becomes someone else's deposit, and every deposit becomes an opportunity for another loan. The system works as long as people trust banks and don't all withdraw their money at once. But loans are only one side of the story. Banks also make enormous profits from interest spread, the difference between what they pay you and what they charge others. Your savings account might earn you 1% per year, if you're lucky. Meanwhile, personal loans, credit cards, and mortgages can charge anywhere from 5% to 25% or more. That gap is pure profit. Even when interest rates rise, banks adjust faster on the money they earn than the money they pay. Loan rates increase almost immediately. Savings rates rise slowly, sometimes barely at all. This delay alone makes banks billions. Then there are fees. Overdraft fees, maintenance fees, ATM fees, international transaction fees, late payment fees. Many of these exist not because they are costly for banks, but because they are easy revenue streams. A single missed payment or small mistake can trigger charges that add up fast. What's more interesting is how banks design systems knowing human behavior. They know people forget dates. They know emergencies happen. They know confusion leads to penalties. The system isn't built for perfection, it's built for predictability. And predictable mistakes are profitable. Credit cards are one of the most powerful tools banks have ever created. They don't just make money when you borrow, they make money when you spend. Every time you swipe a card, banks earn interchange fees from merchants. Even if you pay your balance in full, the bank still profits from your transaction. But when you don't pay in full, that's when the real money flows. High interest rates, compounded daily, turn small balances into long-term revenue streams. Many people think they're managing debt when they're actually trapped in a cycle designed to keep balances alive as long as possible. Minimum payments are a perfect example. They feel helpful, affordable, manageable, safe. But minimum payments are structured to keep you in debt longer, maximizing interest without pushing you into default. It's a delicate balance between pressure and patience. Banks also invest your money. Deposits help fund investments in government bonds, corporate debt, and financial markets. While your savings quietly earns a small return, banks use scale and strategy to generate far larger gains. You take the risk of inflation. They take the reward of growth. And here's the part most people never question. Banks are protected. When things go wrong, governments step in. Bailouts, emergency funding, liquidity injections. The system is designed to protect financial institutions because their collapse would threaten the entire economy. This safety net allows banks to take calculated risks, knowing they are too big to fail. Meanwhile, individuals are expected to manage risk alone. If you lose your job, your loan doesn't disappear. If inflation rises, your savings lose value. If interest rates spike, your debt becomes heavier. The rules are different depending on which side of the system you're on. None of this means banks are evil. They provide essential services. They enable growth. They keep economies functioning. But understanding how they truly make money changes how you interact with them. You stop seeing banks as neutral storage units. You start seeing them as businesses highly optimized, data-driven, profit-focused businesses. And when you understand the system, you can play it smarter. Because the real danger isn't banks making money from your money. The real danger is never realizing they are doing it at all. By now, one thing should be clear. Banks don't win because people are foolish. They win because the system is built on habits, assumptions, and silence. Most people were never taught how money actually works, only how to earn it, save it, and obey the rules around it. From childhood, we're told that putting money in a bank is the responsible thing to do. And in many ways, it is safer than hiding cash under a mattress. But safety doesn't mean neutrality. Every dollar you deposit becomes part of a larger machine, a machine designed to extract value over time. Inflation quietly plays a major role here. If your savings earn 2%, but inflation runs at 6%, you are losing purchasing power every year. Your money looks the same on paper, but it buys less in real life. Banks understand this perfectly. That's why they are always looking for ways to stay ahead of inflation, while depositors slowly fall behind. Time is the bank's greatest ally. The longer your money stays idle, the more opportunities banks have to leverage it. The longer your debt lasts, the more interest compounds. The longer you remain unaware, the smoother the system runs. This is why financial education is rarely emphasized. If everyone understood interest, compounding, risk, and leverage, people would behave differently. They would question fees. They would avoid bad debt. They would demand better returns. And a system built on quiet compliance doesn't benefit from loud understanding. Look closely at how banks communicate. Terms are complex. Contracts are long. Language is technical. The burden of understanding is placed entirely on the customer, and when confusion leads to mistakes, penalties follow. Not because banks are cruel, but because friction is profitable. Even convenience is monetized. Instant transfers, premium accounts, faster services, speed itself has a price. Banks know people value convenience more than clarity, and they charge accordingly. The more rushed your life becomes, the easier it is to overlook the cost of that convenience. But here's the shift that changes everything. Once you understand how banks make money from your money, you stop acting passively. You stop assuming the system is designed in your favor. You start asking better questions. Why is this fee here? Why is this interest rate structured this way? Why does this option benefit the bank more than me? You realize that money is not just currency, it's leverage. Debt can be destructive or strategic. Savings can be protective or stagnant. The difference is awareness. Banks don't fear customers who are broke. They fear customers who are informed. This doesn't mean you must avoid banks altogether. It means you use them intentionally. You keep emergency funds safe, but you don't let long-term wealth rot under inflation. You avoid consumer debt that drains you, while understanding productive debt that grows assets. You read statements. You track fees. You treat financial products like tools, not gifts. The biggest illusion is believing the system is fixed and unchangeable. In reality, banks constantly adapt to technology, to regulation, to behavior, and so can you. Digital platforms, alternative investments, decentralized finance, and global access to information are slowly shifting power back toward individuals who are willing to learn. The future won't belong to those who work the hardest. It will belong to those who understand systems. People who know how money flows don't panic during change, they position themselves. They don't chase returns blindly, they calculate risk. They don't blame banks, they outgrow dependence on ignorance. Banks will continue to make money from money. That will never stop. The question is whether your money works harder for them, or finally starts working for you. Because the moment you understand the rules of the game, you're no longer just a player. You're a thinker. And thinkers don't get used. They get ahead.